Big changes are coming to our tax and financial system starting this month. But here is the most important part. That is, if you're filing your ITR by July 31, 2026 for annual year 2025-2026, you will still follow the old rules under the 1961 Act. The new rules will mainly apply to returns for the tax year 2026-2027, which will file next year. Well, several forms have been renamed, filing deadlines extended, upfront tax on international payments reduced, and PAN rules updated. Well, let us break it down so you know exactly which form to use, how to manage your finances, and how to stay compliant. Forms, simplified and unified. Let's start with the forms, which have now been simplified in order to make your life easier. TDS exemption declaration. Earlier, taxpayers had to choose forms based on age and type of income, like Form 15G for individuals under 60 and Form 15H for senior citizens. Now, Form 121 is your one-stop declaration for everyone. It covers interest income, rent commissions, and other sources, helping you avoid confusion and filing mistakes. Meanwhile, salary TDS certificate. Form 16 used to report salary income and deductions has now become Form 130. It records your salary paid, tax deducted, and employer contributions. Mostly a name change, but this makes filing, verification, and even loan applications much simpler. On the other hand, non-salary TDS certificate for freelancers, investors, and property owners. Form 16A has now been replaced by Form 131. It captures bank or post office interest, rental income, and freelance or commission earnings. With this, multiple income streams can now be reported clearly in one certificate, that is, reducing errors and streamlining filing. And for your complete tax credit system, earlier Form 26AS showed TDS, refunds, and advance payments. Now Form 168 gives you a full financial snapshot, that is showing all the taxes paid, refunds received, and advance payments made. Make this your first stop before filing your return, and it's your comprehensive reference in order to ensure that everything matches. And for NRIs, if you are an NRI dealing with property in India, earlier, both PAN and TAN were required for transactions. Now only PAN is needed, which reduces paperwork, speeds up property registration, and makes compliance much simpler. Now let us shed light on PAN card and financial transactions. Big changes are here for PAN rules and financial transactions. From property deals to cash withdrawals, the limits have been revised, rules tightened, and compliance is sharper than ever. So what is old versus new? Let's break it down quickly and clearly. First up, the PAN itself, that is the new PAN application forms. That is the backbone of the financial transparency. The government has introduced new PAN application forms in order to make things more specific. That is Form 93 for individuals, Form 94 for businesses, Form 95 for foreign individuals, and Form 96 for foreign corporations. This ensures that everyone from local taxpayers to foreign entities is properly tracked. Well, firstly, let us understand about the requirement of PAN. Let's start with real estate transactions, that is, property registration. Earlier, PAN was required if the property value exceeded Rs 10 lakh. Now, PAN is required only if the property value is above Rs 20 lakh. That's right. The threshold has doubled, and it is going to be a relief for smaller buyers, but high-value deals are now more closely tracked. Meanwhile, for bank cash deposits, earlier PAN required for deposits above 50,000 rupees. Now PAN required only above Rs 1 lakh. That is, limit has been increased, but large yearly deposits are still under income tax radar. And on the other hand, even your lifestyle spending is being monitored. In hotel and restaurant bills, earlier PAN required above Rs 50,000 and now PAN required above Rs 1 lakh. You can spend more without PAN, but luxury spending is still under watch. Now talking about vehicle purchases. Earlier, PAN was required for all the vehicles, and now PAN is required only for high-value vehicles. That is, smaller purchases get relief, but premium buyers, you are still in focus. And for the post office deposits, earlier PAN required above Rs 50,000. Now, PAN required above Rs 1 lakh. Same pattern, that is higher limit, but monitoring continues. And here is an important one, that is insurance policies. Now PAN is compulsory for all the policies and no minimum limit required anymore. Whether it is health, life or ULIP, PAN is mandatory and there is no exception. Now talking about large cash withdrawals. PAN required if single transaction is more than rupees 20 lakh or yearly withdrawals are more than rupees 1 crore. That is, big cash movements is equal to full visibility to income tax. And for mutual fund investments, PAN is always required. Investments are always tracked, that is, no relaxation here. And in case of high risk monitoring, even if PAN is not required, certain transactions are automatically reported. That is, cash transactions are more than rupees 10 lakh yearly, credit card cash payments are more than rupees 1 lakh, and current account deposits are more than rupees 50 lakh. Well, the system is watching even when limits are higher. There is going to be a final warning, that is, link PAN with Aadhaar. And finally, do not ignore this. Link your PAN with Aadhaar by June 30, 2026. Otherwise, your PAN becomes inactive and blocks financial transactions. That is, no PAN is equal to no financial transactions. Simple as that. So what is the big picture that we are currently looking at? That is, limits are higher, compliance is stricter, monitoring is stronger. This is not relaxation. It is a smart tracking which allows us to spend wisely, report correctly and stay compliant, because the system is now sharper than ever. Now let's talk about income tax return filing, because this is where deadlines, penalties and flexibility all come together. Well, and for financial year 2025-2026, there are some important updates that you simply cannot afford to miss. Let's start with salary taxpayers, that is ITR 1 and ITR 2. Earlier, deadline was July 31 and now deadline remains July 31, 2026. That is, late filing penalties continue between rupees 1,000 to rupees 5,000. No change here, and if you are salaried, July 31 is still your most important deadline. Miss it and penalties kick in. Meanwhile, there is relief for businesses and professionals, that is ITR 3 and ITR 4. Earlier, deadlines varied between July 31 and October 31, and now deadline extended to August 31, 2026. And that's roughly 1 extra month in order to prepare and file. It means more time, which means better accuracy and a welcome relief for businesses managing complex accounts. Now here is a major flexibility boost, that is the revision window. Earlier, you could revise returns till December 31, and now it has been extended to March 31, 2027. That's 3 extra months to fix your errors. Made a mistake? Relax. You now have more time to correct it without last-minute stress. And on the other hand, the government is also tightening compliance through updated ITRs. Now you can update returns for up to 4 years back. But there is a cost, that is 25% to 70% additional tax plus interest. Well, there is a smart balance, that is more chances to correct mistakes but with a price for delays. Now let us talk about penalties and interest, which is the cost of delay. After July 31, rupees 1,000 to rupees 5,000 penalty will be applied. And interest, that is 1% per month on unpaid tax, and continued delay increases your total liability. Well, delay is expensive. Penalties plus interest can quietly build into a big amount. So what has really changed? That is more time for businesses and professionals, longer window to revise returns, and ability to update returns up to 4 years. But penalties remain strict, even if you delay. So what are the other key updates that we are looking at? That is transition to new Tax Act. Income Tax Act 2025 and Income Tax Rules 2026 are now in effect. But if you're filing your ITR by July 31, 2026 for AI 2025-2026, you still follow the old 1961 Act. New rules apply mainly to tax year 2026 and 2027. HRA and rent relief. More cities now qualify for 50% HRA exemption. Hyderabad, Pune, Ahmedabad and Bengaluru join the earlier list, and claims require landlord's PAN and proof of rent paid. Allowances and perks. Meal card exemptions increased to rupees 200 per meal, which yearly limit is rupees 1.05 lakh, and children's education allowance, that is rupees 3,000 per month per child, that is up to 2 children. and hostel allowance rupees 9,000 per month and per child. Share buyback taxation. Now taxed as capital gains, which can reduce your tax burden. TDS, TCS simplifications. Property from NRIs can deduct TDS using PAN only. And foreign tour, education, medical payments have reduced upfront tax of 2%. So in order to sum up, India's tax and financial system is now clearer, faster and more transparent. Forms are simpler, PAN rules are stricter but fair. International payments are cheaper and ITR filing is more flexible. So collect your income and salary statements, verify bank and investment data, link your PAN with Aadhaar and file your returns on time. Because mistakes can be corrected but delays cost money. The Indian tax system has become smarter now. It's time for you to be smarter too. That's all for now. Stay tuned to the Savera for more updates. Do like, comment and subscribe to the channel.